Hey guys, welcome back to Invested. And just taking a quick question, and I thought it was very interesting given that it's a simple question, but it can get complex. The post says, thinking about triple net investment with 1.5 million on cash. Hello everyone, first time posting here. I will liquefy some real estate investment I have abroad, and I'm expecting about $1.5 million to be on my hands. I want to make an investment that is safe and possible and giving me a decent cash flow. I was thinking about purchasing a couple of apartments, single family home in the area of Chicago, but the idea of being a landlord again is not very appealing. I have been a landlord since I was 15 years old in my country, and I totally hate it. My other plan was to purchase an absolute triple net deal of 15 plus years remaining of the contract, probably out of the state, and pray for the best. Even though I was born in the US, I've been living my whole life abroad, so I do not have a good idea of the market in the States. Besides all that, I've been studying lately in a forum and books. I would like to hear your advice, stories, and what kind of due diligence you people do before buying triple net investments. Also, pros and cons would be highly appreciated. I will be moving to Indiana if that matters, and most of the deals I can find on Crexy are out of state. Thank you in advance. Good question. I mean, it's a simple question. I think it's a heartfelt question. And I'll like to kind of give it to you a general format, not to get too technical, but currently in the United States, the landscape that we're in is really challenging. Why I say challenging is 2-3 years ago, our interest rate or lending rate was almost at zero at Fed rate. So that kind of really spurs up valuation of the property. So right now, you got to really think about your risk-free rate. So when I say risk-free rate is a qualified institution, if you put in $1.5 million, how much interest can you make? As an example, Apple savings account gives you 4.15, the American Express savings give you, 4.3. So there's a lot of different things where you can get interest payment that has minimal downside principal risk. When I say principal, your initial equity risk, or even the 2-year, 5-year treasuries. You can see 10-year treasuries are like 4.6% today. So taking that into account, when you're looking for a solid triple net high credit, they're going to be expensive. And when I say expensive is because since they are good credit and you have a long WALT, which is average weighted lease term. So you say 15 years, that's the WALT. So the longer it is and the credit of the tenant, the property is going to be expensive, right? It's a two-pronged approach, length of time and the credit. So that's what you're looking at. So if that's the case right now, you're getting like a triple net credit tenant as an example using, let's say, AutoZone or even like, because they're investment grade, or like Dollar General. Those guys, you're going to still look even in the tertiary market like Indiana and Chicago or suburbs of Chicago in the Midwest, you're going to get like close to 6.5%, 7%. But granted, it's easier having multi-tenant or apartments where things could break because this is absolute triple net. So what that means is the tenant is responsible for all the property taxes, the insurance, and the maintenance of the property that they lease. And on top of that, they have to give you base rent. So that's going to be the most hands-off passive investment, but you're going to get that yield. So maybe 7% cap, maybe even less if you have that credit, right? So that's what you have to kind of think about it. Well, I can put it into U.S. savings account or bonds and make maybe 5.5%, 6%, or go buy a triple net investment that pays 6.5%. Yeah, 6.5% is higher, but there's still that risk. Even Dollar General going BK, and now they're not going to pay you rent, all that headache. So I think you have to get more return to make that decision. So, I mean, if you're getting like 5.5% of the savings, but with the triple net, you can get 10%. Sure, I think that's a better risk reward that you can do, but not on a 150 bip spread. And after, usually a year or 5 years, when there's rent escalation, of course, you're going to get higher returns. So that's why a lot of, real estate investors will do these type of investment deals, because you get annual escalation or some marker of escalation. On top of that, there's tax benefits of owning real estate versus just savings account. So if you made $1,000 in interest, government's going to tax you that $1,000 interest payment. But if you made $1,000 in real estate, there's depreciation or accelerated depreciation on the cost segregation. So your land and improvements. So you may make $1,000, but you might have negative $2,000. And now you can take that deduction on your income and you probably get some refunds back where there's no tax implication for you. So those are some other items that most people don't think about. They just kind of look at the apple to apple. But to make it really apple to apple, real estate is going to have that component. So I think you really need to think about risk reward currently in this landscape. With the 1.5, I think it pays to be a little bit more patient. So put that money away, start looking at the assets and start doing your due diligence on credit. I mean, is the tenant doing well? As an example, you're not going to go buy JCPenney or Macy's because they're not doing very well, or even the gyms these days because they're just not doing very well. So even though they have 15 years, how likely is it that they may not be in the business in the next 5 years? So those are something that the due diligence, you have to really underwrite the tenant, underwrite the market, as in the submarket, the region, and also the vintage and the quality of the building as well too. If you found this content helpful, please subscribe, like, and follow. Thank you.